Have you ever wondered how billionaire investors like Warren Buffett made their money? What are they doing differently with their investments that has helped them grow their wealth exponentially over decades? In today's video, I want to talk about the 6 biggest investing mistakes regular people make over and over, but the rich avoid big time. I'll share these so you can sidestep the same errors and start building wealth like the pros. And before we dive in, please take a quick second to like this video and subscribe to the channel for more videos about investing and personal finance tips. Now, let's get into those 6 biggest investing mistakes. Mistake 1. Investing in things you don't understand. Have you ever been tempted to invest in the latest hot tech stock that everyone is talking about, even if you don't totally understand the company's product or business model? Well, here's why that could be a costly mistake. Warren Buffett's one rule is to never invest in businesses he doesn't thoroughly understand, even if they seem like amazing money-making opportunities, even if everyone else is pouring money into the industry. Buffett's philosophy is that if the product or service is too technical, too new, or too complicated for him to wrap his head around, he simply passes. It's not worth the risk. He only puts his money in simple, predictable companies with straightforward business models. Things like food, insurance, and well-known consumer brands. This avoids making risky gambles in fast-moving industries that Buffett is unfamiliar with, even if that means missing out on some hot investments. Mistake 2. Trying to time the market. Predictions of impending stock market crashes or promises of big short-term gains tempt many investors. Selling or buying based on these predictions is appealing. However, market timing is incredibly difficult, even for professionals. Let me explain why reacting to predictions rarely pays off for long-term investors. The rich know that timing the stock market well consistently over the long run is nearly impossible to do successfully, even for the full-time professionals. There are just too many macroeconomic variables and unpredictable market shocks that send stocks fluctuating wildly in the short run. So instead of trying fruitlessly to predict precisely when ups and downs will happen, the wealthy use a long-term buy-and-hold investment strategy coupled with dollar-cost averaging. This avoids the massive mistake many amateurs make of panic selling in emotional reaction to scary-sounding news reports whenever stock prices temporarily dip. Mistake 3. Not investing at all. Ever hesitate to invest because you're afraid of risk and losses? Convinced investing is just glorified gambling that you should avoid. Well, here's why not investing at all could be one of the biggest money mistakes you can make. The wealthy know that one of the biggest financial errors most ordinary middle-class people make is to not invest their money at all outside of cash savings accounts. While the stock market certainly carries risks, especially in the turbulent short term, history shows that long-term average returns across diverse asset classes are extremely positive over multi-decade periods. Even modest investments made consistently over 20-30 years can result in incredible wealth creation through the power of exponential compound growth. Mistake 4. Taking too much risk. Ever hear stories of reckless speculation making people rich and wonder if you should take more risk too? Here's why the wealthy tend to avoid crazy, risky bets. While financially successful investors are certainly willing to take on some smart risks with their money in pursuit of higher returns, they still avoid excessive speculation which can wreck portfolios. Things like putting the majority of your life savings into 1 or 2 red-hot momentum tech stocks at sky-high valuations. Ultra-conservative long-term billionaires like Warren Buffett instead opt for less aggressive risk and slower, but more dependable compound returns by investing mainly in established, profitable companies with good fundamentals, instead of making big, concentrated bets on flash-in-the-pan industries full of unprofitable upstarts. Mistake 5. Chasing past returns. Ever look back and kick yourself for not investing in asset classes that did really well in recent years? Here's why hindsight can fail you. Wealthy investors studiously avoid the common mistake of pouring large amounts of money into specific asset classes solely because they have performed extremely well in the recent 1 to 3 year past. This chasing returns approach often results in overpaying for investments right at market tops, effectively buying into bubbles right before they inevitably deflate. The rich know from hard experience that astronomical past returns often reliably mean lackluster, or even negative future returns over the next decade, as markets correct and revert to the mean. Mistake 6. High investment fees. Ever hesitate to invest or put more money to work because fees seem to eat up potential gains? Well, the ultra-rich have figured out how to eat everyone else's lunch by avoiding this mistake. The number one fee mistake that keeps most middle-class investors struggling is paying excessive asset management fees and transaction commissions to investment managers, stockbrokers, and financial advisors. The simple truth is the more you pay in fees and costs, the less overall profit you keep. Mega billionaires like Warren Buffett avoid fee leakage by choosing diversified, passively managed stock index funds from Vanguard instead of expensive, actively managed mutual funds promising to beat the market. As the legendary investor Buffett preaches, investment costs matter a lot. Minimizing fees maximizes long-term wealth. Now, I have a question for you. Which of these 6 biggest investing mistakes that the ultra-rich avoid is going to be the most difficult for you to change in your own investment strategy? Let me know in the comments. If you enjoyed this video with investing tips from the rich, please like and subscribe for more content. Thanks for watching and see you in the next video.